Hello, everyone, and welcome to the Currency Exchange, a NatWest podcast series all about foreign exchange markets. I'm Brian Daingerfield. I'm a G10 FX strategist here at NatWest, and I'll be your host today. There's a lot of political drama going on, both in Europe and in the US. And to break it all down for foreign exchange markets, I'm very happy to be joined by Paul Robson, who works with me in the G10 FX space. Paul, thanks very much for joining.
Well, thanks as ever for the invitation. I like the way you've introduced it in terms of political drama, and that certainly feels like we're getting quite a lot of political drama on both sides of the Atlantic, and coming a little bit earlier than perhaps we thought earlier on in the year.
Yeah, that's certainly true in Europe, where we have earlier than expected election in the UK, and we also had much earlier than expected elections in France, and certainly here in the US, the market reaction to the debate. The presidential debate has sort of pulled forward market reactions in some senses to changes in the presidential landscape. But before we get into the specifics of some of these votes, Paul, I wanted to ask you about maybe take a bit of a step back and think about what's sort of the broader strategy that we should be thinking about, how FX focused investors should be thinking about elections. How are you thinking about elections as relates to FX? And what are some things that maybe you think differentiate your approach to some others?
Yeah, my framework for looking at political events is relatively simple. As with you, Brian, we have 10 currencies to consider on a day-to-day basis. Sometimes people want views on 20 or even 30 currencies. So I think simple is always best when you're looking at these political events, especially events that's outside of your own borders, because they start to get a little bit more complicated. My framework is really based around what I learned during Brexit, for example, and the UK's exit from the European Union and the Scottish independence referendum. And that sort of time and that framework has proved to be a good friend when we think about other political risks in other countries and the impact on those currencies. So I used that framework for looking at lots of other currencies. So what is that framework? As I say, it's relatively simple. You have a political event that has a set of different outcomes that have different probabilities and different expected impacts on currencies. And the valuation of a currency at any particular time is just a weighted average of those outcomes. And that gives you your current valuation for today. And if you have a different view on those probabilities or those expected outcomes, that allows you to be more positive than the consensus or more pessimistic than the consensus. And I think when you look at risks at the moment, especially in France, and we'll get onto that, I'm sure, in a minute, you have a range of outcomes. You're thinking about the extremes in the distributions. When you actually get the event, that distribution collapses down to your central case, and the market impact will depend on how you thought the risks in those tails were priced. And that's how we're definitely approaching the risks that we're seeing in political markets at the moment. Brian, do you see it in a similar way, or do you think that's a fair and an appropriate way of looking at it?
No, I think that's absolutely the way that markets, I think, should be interpreting not just these political events, but really a lot of the economic data, changes in Fed expectations. We spend a lot of time on the podcast talking about how shifts in market expectations affect currencies and how we think those shifts in expectations, whether they are appropriate or maybe out of line with fundamentals, and whether or not that creates opportunities. That's the case in terms of expectations for Fed pricing, for central banks, for economic data, for growth. And I think it's certainly the case for elections as well. Elections are maybe a bit more singular events because they're not as frequent and the potential changes are quite a bit larger in some cases. But I think it applies in a lot of cases. Current asset prices are a snapshot of market expectations for a lot of different things, all sort of bundled up nicely into one simple number, one exchange rate, right? And so as those expectations change, I think that's a really nice way to think about it as relates to some of these big events that are both upcoming and will be driving things for the foreseeable future here. So, Paul, I want to dig into the specifics of the French election. As we record on July 3rd, we are sitting nicely between the first round of the French vote and the second round of the French vote, which happens this coming weekend. Paul, what do you think? Can you talk to us about what happened in the first round of the French election, what you think that means for euro, and what maybe the implications are from the first round as we look ahead to the second round, and what the implications of that could be on the common currency?
Yeah, in terms of the first vote that we had last Sunday, I don't think it had a big impact on markets. I think it was largely as expected. Maybe it gave people a little bit more confidence in the sort of consensus central case that was generally preferred by people. So you had the first vote. I think it just solidified people's thoughts that you are likely to get a hung parliament. You might get the right getting a majority, but crucially not an absolute majority. And I think where markets were were a bit more comfortable was that the far left perhaps didn't do as well as feared. And I think when I've been out talking to clients about this is what markets tended to fear the most. I think that they had become a little bit more relaxed about a move to the right. Personally, I think that over time that view might be revisited, and it might not be so sort of neutral for the economy, nor with a sort of hung parliament outcome. But for now, hung parliament is seen as being the most likely outcome by quite a long way, and market friendly in terms of euro. And the euro has done a little bit better. Vol markets, people aren't expecting such currency moves in the future than they had done previously. So into the second round, and that comes, as you say, on next Sunday. There's still a lot of uncertainty around this. You get strategic partnerships between the parties. Opinion polls aren't always right. People can vote one way in the first round, see how everyone else votes, and changes their view. So if we got a sharp move to the left, I think that would play negative for the currency. But I think under the central case, as the distribution of possible outcomes that I was describing earlier collapses, people realize you're not going to get the extremes, then maybe the euro does a little bit better. But I think that's better priced. I think longer term, I think that this political event just echoes into the future. I mean, I described it in last week's weekly as the political cat out the bag by Macron. I think people had become a little bit complacent about the political risk premium in the euro. I think we described in previous podcasts how that had been squeezed after COVID and the energy crisis, because people thought it was much better to be together than apart. And I think that had seen, especially European bond markets, reflect that, less so the currency. But Europe needs strong leadership at the moment. France needs strong leadership. Europe at a pan-European level is being squeezed by the US on one side and China on the other side, and a policy response in Europe is needed. And for the French economy, like a lot of developed countries, large fiscal deficits, relatively weak growth, the outlook is challenging. And having a hung parliament for the next year, it doesn't feel that great to me. So whatever you thought the euro might do, say euro dollar into the future, I think that risk premium persists. And that, again, will be the lasting impact of, I think, last week's first round and ultimately the second round on Sunday.
Yeah, when thinking about lasting impacts of the elections that we're seeing now, rather than necessarily the ultra near term, I think that's a good opportunity to transition to talk about the UK election. Now, as I mentioned, we're recording this on Wednesday, the day before the UK goes to vote. So there's a decent chance that by the time you listen to this, and we as well will have seen the results. Paul, with that in mind, I won't necessarily ask you what you think the result will be, but I want to ask you how you think markets should be thinking about these various scenarios, maybe from a more holistic perspective, if we get the results in line with what polls are suggesting, for example, or, what kinds of results do you think we could see differentiated market reactions?
Yeah, I actually have less to say on the UK election in terms of market impacts than I do on the Euro and the French elections. And I'm sure when we turn to the US, I'm sure you'll have a lot, because the UK all of a sudden looks like an island of political stability. I don't think I've used those words in a sentence for the best part of, I don't know, 10 years or so. But it just shows how quickly things can change. And when I think about politics, I think you assigned it to the long list of specific UK risk factors that have fallen by the wayside over the last year. This was one of our key themes in our year ahead that we published all the way back in November. We thought that the risks around the UK economy were receding, and I think this is an example of that. Other things like the bond market and financing large deficits, current account funding, housing markets, Scottish EU referendum, EU trade, all these things haven't happened. So I think that's important. As you say, the polls have been pretty stable, predicting a fairly large majority for the opposition Labour Party. And that seems to be the base case for a lot of people. So I think and I think some people see that as being the continuity of policy, reduced political risk, as playing slightly positive for the currency. But I think that's likely to be already in the price. There's a little bit of uncertainty about if we got a super large majority. Some people talk about a super majority. That doesn't officially exist in the lexicon of politics here in the UK, unprecedented majority, and what that might mean in terms of fiscal spending or government spending and borrowing, whether it leads to bigger deficits, and what it might mean for the UK's relationships with the European Union. And that's the uncertainty. I mean, I say uncertainty because the Labour Party has been very clear on their views that nothing is set to change. But given the currency moved a long way through the whole of the UK leaving the European Union, maybe even small changes in probabilities leads to some support for the currency. But you've got to offset that, I think, for worries about fiscal policy. And obviously, when we think back to previous governments, how that's played negatively through the currency. So I come down to buy the rumour, sell the fact when I think about the election, which is pretty standard for a strategist like myself. But as I say, not too much on the UK election, but it feels like US election sort of focus has increased quite significantly over the last couple of weeks, coming a lot earlier than expected. I look at some of the betting markets, and they seem quite excited. So I was just wondering whether you're just as excited, having watched and listened to the debate, and does it really change anything for you?
I don't know if I would say that I'm excited, having listened to the presidential debate, an hour and a half of riveting television. Not exactly riveting for reasons that are not exciting. But look, I'm getting off point a little bit here. But stepping back a bit, one of the things that we have been hearing in our client conversations around the US election was that most believe that this was a very significant event and had very significant potential risks for markets, but that it was not a specifically tradable event this early in the year, because we have so much between us and November 5th election day. That includes changes in US economic outlook, the Federal Reserve, what's happening with the timing of the first rate cut, for example, what's happening in elections across the pond. As we just talked about, France and UK elections are much more in our immediate horizon than the US. That impulse appears to have changed in light of the debate. The debate on last week, President Biden did very poorly, and voter concerns about his age and stamina and his ability to win a second term at his age increased substantially because of his relatively poor performance. And as you mentioned, betting markets adjusted quite significantly to this, where at one point, former President Trump's odds had risen above 60%. to win the presidency in Predict It, for example. That's not just his best implied odds of 2024. It's also better than his odds at any point in 2020. Now, that was an election he lost, but remember, that also includes the pre-pandemic period when Trump was generally expected to win based off of a strong economy. And so Trump's position in betting markets now is better than it was at any point in 2020. And that's really a testament to just how far Biden's own odds have fallen. Another thing to consider is that when you compare odds in the betting market of Biden versus odds for the Democratic Party being the party that wins the presidency, what you see is a gap has opened up between the two, where the Democratic Party winning the presidency is much higher implied odds than Biden himself being the next president after the 2024 election. So that's the betting markets telling us pretty clearly that there is a gap between the Democratic Party and Biden being the nominee. So it's clear that this speculation that Biden will leave the race because of his poor debate performance has gone up pretty sharply. And so this, I think, it's really crystallized some of the risks around a Trump victory in the mind of the market, where I think we felt that Trump was a modest favorite going into the debate, seeing the market pricing and roughly, the polls were telling us that Trump was a small favorite. Betting markets are sort of around 50-50 going into the debate. We felt that that was probably going to be the case all the way up until election period. That because of the polarized society, the fact that most people don't seem to be particularly fond of either Biden or Trump, that it would be very difficult for one candidate to really take a definitive lead in either betting markets or in polls. But it looks like this is an opportunity for Trump to take a much more material lead over Biden. And the way that markets have reacted to that is we have seen some steepening in interest rate curves. That might be consistent. It certainly is with our expectation that a Trump victory is the scenario where it's most likely to be accompanied by additional fiscal stimulus if he wins with United Parliament. With United Congress. We're talking so much about the UK. I've got Parliament on the mind. If he wins with United Congress, then that could lead to additional fiscal stimulus and additional borrowing. And we think that's the scenario where the risks to the long end of the Treasury curve from higher term premium are the most potentially extreme. On the dollar side, it's been more mixed. As you mentioned, Paul, there's a lot of cross currents for the dollar right now, coming from what's happening offshore. For dollar crosses, of course, what's happening in other economies is, of course, an important input into the dollar. But we have seen in the rates market, we've seen some steepening of the curves. And I think that does reflect, in some senses, this increased odds of Trump winning. So the election has certainly, I think the risks around the election have crystallized recently because of how much the debate shifted the odds in markets and turned Trump from being a modest favorite to being a clear favorite to become the next president.
Yeah, it does sound like there's going to be a lot to discuss around the 4th of July Independence Day barbecue. So it'll be interesting to see how everyone comes back after the weekend. So I think you sort of covered pretty much everything. But let's just say that Biden does choose to step down. Maybe he's with his family over the holiday period. Does it really change very much for you in terms of the dollar view?
Paul, I'm actually really glad that you asked this, because I think this is an important thing to highlight here, is that the difference in terms of policy outlook, which is what really matters for markets, the difference in policy outlook is probably not materially different if you compare Biden with an alternative Democratic choice at the top of the presidential ticket. Because the Democratic Party, the platform of the party, is pretty widely agreed upon across the spectrum of its key leaders. This really is not the same in the Republican Party. If the shoe was on the other foot and we were talking about the Republican Party, the difference between Trump and Nikki Haley could be quite significant in terms of additional fiscal spending, the way we're thinking about the active versus passive trade war, differences in opinion on Ukraine, Russia. Those things could be materially different, Trump versus an alternative Republican. That's just not the case on the Democratic side in our view. We have the Democratic platform of not increasing taxes on anyone making under $400,000 a year, but instead increasing taxes on the corporate tax rate and increasing taxes on wealthy Americans in order to pay for additional stimulus, whether that be in the form of expansion of the child tax credit, additional green spending, and other social spending like improving the ACA, improving access to healthcare. That's something that's very, very widely agreed upon at the top levels of the Democratic Party. At the same time, things like reestablishing Roe v. Wade are also very much in line with the Democratic Party platform and are unlikely to change based on who the nominee is. Where you do see some potential for differentiation comes from foreign policy, simply because we don't know. A lot of the potential candidates that could consider contesting the nomination if Biden were to step down don't have a lot of foreign policy experience. The one place where it looks pretty likely that you could see some differentiation would be on Israel, the Israel-Hamas war, because that's probably the one foreign policy issue where you see the biggest divide within the Democratic Party. But other foreign policy initiatives, supporting Ukraine, for example, supporting Europe, trying to keep a positive relationship with our allies and use that relationship to continue to work together in terms of strategic competition with China, that's likely to remain the same under a Biden presidency or a Biden nomination versus an alternative Democratic nomination. And so when you take these together, we do think that the implication of Biden leaving the ticket, if it were to happen, and let me just say out at the outset, we've been faders of this speculation, and I continue to think that Biden will stay in the race, although I of course could see that the risk of him dropping out has increased substantially in the aftermath of the debate performance and the shift in his polls in the aftermath of the debate. But even if he does drop out, we have to be thinking about market scenarios, not based on who specifically is the president, but what the president means in terms of changes in fiscal policy, changes in foreign policy, and changes in relative growth and economic expectations between the US and our peers, which is, of course, what matters for foreign exchange markets. And if we just take a step back and think about what the markets might do in the aftermath of the election, a lot of our expected market scenarios are really Trump specific, as in Trump himself brings such a difference in terms of political changes, in terms of foreign policy changes. Most of our market scenarios are really more about Trump, and that we think a Trump victory implies a stronger dollar based on a resumption of America First trade policy and also the potential for additional fiscal stimulus if he wins with united government. Biden win scenarios, in our view, are less about pricing in a specific Biden premium into foreign exchange markets, but it's more about pricing out of Trump victory related risks in markets. If that dynamic is right, if our view on that front is right, then it doesn't matter as much for markets whether Biden or a different Democrat is at the top of the ticket. Because if markets are all about pricing in Trump versus pricing out of Trump as the first order reaction in FX markets to the result of the election, then the specifics of the Democratic side don't change. It's still, the Democratic victory scenario is still pricing out Trump. Last point here is that Democrats are facing a very difficult uphill battle in terms of the Senate majority. They have a very difficult calendar this year. They're defending a lot of vulnerable seats. So even if Biden and the Democrats were polling better, they might still lose the Senate to begin with. And so even if the Democrats win the presidency, we're looking at more likely than not that being a split government scenario, which is effectively what we have now, a Democratic president without united control. And so the kinds of fiscal policy changes that Biden or the Democratic nominee would want to make may simply not come to pass, even if Biden or the Democrat does win. And so we're thinking about the market scenarios that we're eyeing are all about pricing in or pricing out of Trump. And so I think it's an important thing to think about as we think about what Biden leaving the race would potentially mean for policy and for currency markets. And on both of those fronts, we actually think the feed through would be limited. The one real place where it could come through is, does Biden leaving the race suddenly improve Democratic odds of winning the presidency? And sort of because Biden himself is polling so poorly and his unpopularity is relatively high. That's probably the big feed through. But in terms of what does a new candidate mean for policy, we don't think it means much because the main policy beats from the Democratic side are pretty united. And what does it mean for markets? We still continue to think that Trump and Trump-related risks are going to drive the market. And so any non-Trump candidate that wins, whether it be Biden or someone else, probably is, that dynamic we don't think has shifted. So Paul, thank you very much for joining. We covered a lot of ground today, talked about a lot of big political events and what they mean for currency markets. And we will see what happens in the UK election coming up tomorrow. And to our listeners, thank you very much for joining. As always, if you liked this podcast, please consider giving it a like and subscribing to our channel so that you get our latest content the moment it's released. Thank you very much.